Yeah, good point. It's always good to see that somebody is focused on that. Okay, we started that. Okay, so let's start here. We are see where we are in terms of maybe the. So we have done the gamma theta trade-off and the vega theta trade-off. So I'll just mention a little bit about 10-11. I think we are now on the 17-11. Okay. Oh, 11-11 was the last class. Okay. So I'll just mention, so as I said, we discussed the gamma theta trade-off, which is a very important concept in option trading, but it applies only for market makers, and you guys are not going to be learning. So when you learn option trading, it's you learn it from two perspectives. One is as a market maker and how to serve, and that's one perspective, and the other perspective is that of a price taker. So you guys are learning the second perspective, but it's very important to know about this. Okay, because there's actually more material on this than there is on this in the option literature. So therefore, you have to be aware that this kind of problem and this kind of perspective exists, but you haven't learned about it. So you have some idea as to what it is. Long options will have long gamma, but they'll have negative theta. So you have to balance that trade-off. And the vega theta trade-off is very similar to that. Okay. In fact, we'll just add one more point here. This is where we stopped, that the vega theta trade-off, it's the same thing. Trade-off means you try to do something and you have another kind of problem. Okay, so this is what a trade-off means. So the vega theta trade-off, if you go long options, okay, you will be long, or if you go short options, you'll have short vega. If you have long options, you'll have long vega. Mainly, we are concerned with this long option position, okay. So the long option position has, okay, let's keep it this way. It's then we'll talk about the difference a little later on, okay. But the short option position has positive benefits from theta, and a long option position has negative, benefit from theta, in the sense that it loses value with the passage of time. So here, one thing we have to look at is, we have also discussed this. Let me just talk about this here at the trade-off stage. All right, so okay, so yeah, I was just looking at a chat message actually. So if there's anything urgent, just put, okay, some of you may not be able to speak because of your mic not working. So I will have to look at the chat messages. Anyway, so on the trade-off, let's look at it. The long position will be long vega, right? And yeah, so this is basically is that the long option position will have negative theta. And this is the trade-off. And the other thing you have to understand is that I'm just going to put a little gap in here so it's easier to understand. Let's make this one observation. You understand what symmetrical is? Symmetrical means equal on both sides, okay? There's one thing to note here, that the vega theta trade-off is slightly different in nature. And usually people, of course, also another thing to remember, this is very real for you when you do your trading in this particular project. But in industry, people don't talk about this trade-off so much. They mainly talk about the gamma theta trade-off. So when you discuss the vega theta trade-off, you have to connect it to the gamma theta trade-off. and explain what you mean. All right. So, but there is a trade-off involved here. Okay. So it's not very good language, not very the kind of language that I normally like to use. Let me explain what I mean here by asymmetrical and symmetrical. Okay. Now, the gamma theta trade-off, what happens is that if you have, like here, you look at this option. If you buy this option, you will have positive, if you buy both the calls and the puts, okay, and usually when we talk about buying options, we will talk about buying both of them. And when you buy calls and puts, you will have positive gamma. Your position will have positive gamma and your position will have negative theta. Okay. And so therefore, if there is any dramatic movement, okay, when you have this kind of movement, this is even this kind of movement where you have lots of up and down movement going on. It's a lot of uncertainty with the elections and it's things like that. So, so there's a lot of up and down movement. If you have, if we look at Apple as well, which we are trying to focus on today. Apple has a lot of options trading on it. A lot of option, high option volume. So when you have this, you can see the similarity between the Q chart and the Apple chart. So you have this kind of, you just look at this small period, the small time frame here, short time frame. You have this decline up, then down, up again. So all this movement that is happening. So whenever this kind of movement is happening, you have a benefit from long option positions. Okay? They will have positive gamma, and there is a benefit from the long option positions. And whenever there is any quiet period, there is a lack of benefit from option positions and from long option positions. And at the same time, the long option position will always have negative theta. What I mean by the trade-off is not is almost asymmetrical. In the case of the Vega theta trade-off, is what happens is, let me mention this here. Just after this, okay. So this discussion on gamma theta trade-off and Vega theta trade-off has actually been a little longer than I should have made it, because we are running short of time in terms of getting you ready for the project. But it's a slightly sort of theoretical discussion. So let's talk about why this is asymmetrical. Yeah. I'm just opening here, since for long options, theta is always negative. Okay, so that's all I'm trying to explain to you here is that long options doesn't necessarily. It's a little bit asymmetrical here, in the sense that if you have long options, okay, and you have, because the long option has positive theta, positive vega, okay, but if the vega falls, then your option position will still lose value. So basically, what you can happen is that if you go long options, okay, and then I vol collapses, you will lose on both vega and theta, okay, because the theta is always a loss. Now vega, what might have happened is, if we look at this, if we try to look at, maybe pull it back a little bit here, Apple, all right. So this is your eyeball. This, no, Apple is not a good because they haven't adjusted this well for the stock split. Anyway, let's look at this. Maybe they have done it. They have done a better job here. Yeah, they have done a better job with the price chart also, actually. So this is your eyeball chart here on Apple. So if you go long Apple options, okay, if you're a mean reversion kind of player, and you find that Apple options have traded in the range between 20% and 80%, and so then you want to, and it's closer to 20% now, and so you want to buy options, you want to buy Apple options, your IV index mean is over here, and you buy this, okay? So if you buy Apple options, both calls and puts, betting on a rise in eyeball, okay? And what might happen, the reason I'm saying that a vega theta trade-off can almost be asymmetrical, is that you can get killed on both fronts, because your eyeball, actually, if you buy it here and then eyeball keeps collapsing, okay, then your option positions will lose value because of vega, and they will also lose value because of theta, because long options always lose value because of theta. Okay, so we don't have to worry. That's all I meant by that. Okay, that you can get killed on both fronts. Okay, so maybe I should not have spent so much time on this point, but it's just a point that I wanted to mention, that this is what we have. Okay, this is just an addition to the last point that we discussed in the last part of the previous lecture. This is the vega theta trade-off and the gamma theta trade-off. It's a little theoretical, but that's basically that. To understand, the main thing here is that there is a trade-off. Okay, that's what it is. Okay, so let's look at this now. We have to start getting into the theoretical frameworks that will help you to trade. So let's get into that. Okay, so your next topic is option positions and market views. This is where we're getting into the where we're giving you a good framework for you to trade options. Okay. So as you can see here, you have two types of positions. Today also we are not going to do any quizzing kind of thing, because I'm very concerned that I want to give you the basic theoretical framework before you start trading. So then we'll do that in the middle once you've started your project. So you have two types of positions. Okay, remember, you have position types are long and short. Okay, in any asset, any instrument, you only have two types of positions, long and short. I'm not including square. Okay, square is not, sometimes we say that my position is square, but in our discussion we're not including that. Okay, so zero position, we're not calling that a type of position. So let's put it this way. Let's make it even more specific, so that, because I talk a lot about talking in very specific terms. So let's make sure that we are always also talking in highly specific terms. Two types of non-zero positions. Okay, so you have non-zero position is either long or short, and your option types are calls and puts. So therefore, if you combine these, you have four types of option positions: long and short for calls and puts. So you have long calls, short calls, and long puts and short puts. Okay, so these are your four option positions. So I guess we don't have to write this here, you understand that. Okay, so this is the first thing that we have to understand clearly in our head. Very simple stuff, but we are combining two types of knowledge, two types of non-zero positions and two types of options. So you combine them, you get four types of option positions. Maybe we can highlight this here. This is what we are studying here. Okay. four types of option positions, and you can derive that answer from here. Okay. Right. Now here, how do the question that we are asking is, how do your views lead to your option positions, in the sense that what kind of views? So the question is, you've got four types of option positions. Now, which one will you take? All right. So if you look at any kind of, let's look at one of your other tickers. Actually, I don't like the fact that they haven't adjusted for your, let's just look at SPY, and let's just look at SPY tickers, and let's change that. Because I don't like the fact that here they've not adjusted for the stock splits. It makes the whole thing look weird, actually. The chart looks weird. So the interesting thing is that normally in the run-up to uncertainty, we have a rise in eyeballs. The rise has been quite limited, actually. As you can see, as the election approached, eyeballs did rise in the case of SPY, but it's not been a dramatic rise. Okay, so here's your price chart for SPY, and this is a very useful way to look at option trading, the decision framework, because in one chart you have both the eyeball chart, the red line, and the blue line, which is your underlying price chart, underlying asset price chart, which is your SPY, the ETF per unit ETF price of the SPY. So this is what we have. So let's work with this, and I'll just make sure I have this also here. This is just December to December SPY. It's around 20%. Yeah, you'll see this here as well. We have one more indicator. All right. So let's look at this, and let's talk about. So what we are saying is that we have four types of option positions, and so the question is, so how do you decide whether you're going to be long calls or short puts? Okay, how do you take that decision? So this is where we come to the decision framework. Okay. Now remember here that you have always go back to this framework, which I've repeated on many occasions in the course of our discussion. That we have to always think about the option, the price impact. Whenever you see the price impact on options, let me just copy this so that I don't have to write this every time. We have written this in many parts of our notes, but there's a part where I have actually connected it to your intrinsic value and time value. Correct, here. Okay, so let's take this and ceteris paribus. This is the framework that you have to remember. So let's put that price in time. So when we have, so we'll put that down, we'll bring it to the top part where we are discussing this. Okay, we are going to put it, paste it here. Right. So always remember this framework, that the total price of an option is the IV plus the time TV. So IV is connected to the idea of moneyness, that is intrinsic value versus ITM, OTM, and ATM. So when you are looking at ITM and when you're looking at moneyness of options, it's connected to the idea of intrinsic value, which is connected straight away to the relationship between these two, okay, depending on calls and puts. And so the relationship between these two, this is what is driving really the intrinsic value of the option. And of course, once you zero in on a particular option, like say for instance in the case of SPY, you have some option prices maybe here. okay, if we have maybe we have so we don't need symbol lookup actually. Where was the price display actually? We had a price display chart. Anyway, doesn't matter. Doesn't matter. We stick with the IV chart. We'll get that. You saw the price display. There is a price display. So what I was saying is that when you're looking at any option, once you're looking at any option, you're zeroing in on certain strikes. Okay. So once you strike, once you zero in on the strike, then the intrinsic value is completely being driven by the movement of the underlying price. So once you select the option, that doesn't change. Okay, so if you're looking at the 100 call for the SPY, then you're looking at this constant option. That exercise price does not change. What changes is this: the underlying price keeps moving around. So the intrinsic value changes because the underlying price keeps moving around, and intrinsic value is driven by the depending on the relationship that we have, whether it's this minus this or this minus this, that is driven by whether it's a call or a put. And then the intrinsic value. So therefore, essentially, but it's always true that the change in the intrinsic value is going to be driven by the movement of the underlying price. That's what is important. Okay. So what we are saying is, going back to our framework, we are saying that the changes in the price of the option is either driven by intrinsic value changes or this or both. Okay. It could be both. So in this case, what's happening is that so in the case of intrinsic value, it is being driven by changes in the movement of the underlying price, and in the case of if you look at the time value, so as you know that the time value is driven by two main factors. Okay, time value is driven by two main factors. One is, of course, very obviously this. Okay, days until expiration, and the other is the vol input. Okay, because the vol input affects the model's perception of how much movement can happen in the option prices. The greater the vol input, the greater the movement that is possible, and therefore these values will jump up if we increase the vol input. So now, out of these two, there are two things that determine the time value. Okay, the vol, I vol, and the days until expiration. Okay. Now, out of this, we should just write this, that this is one. And time value is, we'll just write one more point here. I'm just going to make a note of this. So you understand this is an important concept. OVM, okay. OVM is option valuation model, which is this one. Okay, this is your option valuation model. So when I'm referring to vol input, I'm talking about this vol input. Okay, what do you think in the percentage number? What do you think will be the one standard deviation price change in your particular? Let's make this SPY. Now we are discussing SPY, not Apple. What do you think will be the one standard deviation price change over 1 year for this time series? So you are already familiar with the idea of standard deviation from your stats classes. So that's all we are saying. When we are talking about this, when you're entering this value into the OVM, what are you thinking about? You're thinking about a standard deviation number, the one standard deviation, which is basically what we mean when we talk about standard deviation. So this is a time series. You can easily understand this concept. This is a time series, okay? And you're thinking about what is the one standard deviation movement in going to be, okay? Not for historical, okay? Normally we have calculated standard deviation from a historical perspective. So you get a series from your teacher, and then you calculate this. So like a historical series, like we know what the data is from here to here, right? There's no uncertainty. You have the data, and then you calculate on this time series, you calculate the standard deviation. So here we are talking about a different kind of, the concept is the same. You're still thinking about the standard deviation, but not historical, but you're trying to make a projection. You don't know what's going to happen in the future, but you're trying to predict what the future will be. What will be the 1 year, what will be the one standard deviation movement in this time series over the next, for any period, annualize one standard deviation movement for any period. So you can see here that there are H-ball and I-ball measures for various periods, 10 days, 20 days, 30 days. The numbers are different. You can see that, okay? Right now, the numbers are different. These are the current numbers. These are 1 week ago numbers. These are 1 month ago numbers, okay? And these are the 52-week high-low for, high and low for these particular ball numbers, historical ball numbers. So as you can see, the numbers are different. That's because they are measured over different days. This is measured over 10-day data series containing 10 values only. This is measured over 20 days, so the series has only 20 values, and this one has 30 values. And the numbers are all different. So what are these? But they're all the same numbers. These are the annualized one standard deviation movements, okay, that have been calculated from this much data in historical numbers. But when you're talking, this is historical volatility. And when you're talking about implied volatility, it's a forward-looking measure. You're thinking about the same kind of things, but you're thinking about them for the future. Okay, so that's the number that we are talking about. That's what we're talking about here. Now here, what we mean is, so these are so when you're talking about the vol input. So I came to this part of the discussion where I was talking about the both implied volatility, which is what is implied volatility. Volatility is the vol input in the option valuation model that produces a, we are repeating that definition, a fair value estimate, okay, equal to the market price. Fair value estimate for option prices equal to market prices. We're talking about prices. Why prices? Because we're talking about both calls and puts. These are the fair value estimates for the option prices, and they are based on a particular input. Here right now I have 25. If I change this to 45, these numbers are going to jump up. Okay, so these estimates are coming from this input. So eyeball is that input here, which will create this kind of output equal to the actual market price. Remember, this is a fair value model. This has nothing to do with the actual market price per se. This is just your what is happening in your mind. You're saying that, okay, if these are the inputs, these should be the outputs. But these need not be what is happening in the real world. The real world, whatever is happening is shown in the market price. So if you want to match these to the market price, you enter a vol input, which produces this output equal to the market price. Okay. So the point I'm trying to emphasize here when I'm talking about the second part of this statement, that option prices are driven by changes in IV and TV. And when it comes IV changes, you already understood how they are driven. They are going to be driven by the movement of this underlying price, because this is already fixed. Once you lock into an option, this is fixed. So this relationship is driven completely by this movement, which is moving around all the time. And as far as the time value movement is concerned, I was talking about the movement of time value. I was saying that both eyeball, and I'm just repeating the eyeball definition here. Okay, so maybe I should not have done that, because some of you have said that there's too much repetition in the course. But this is such an important concept that I wanted to repeat this. Both implied volatility, okay, and both of these affect the time value. Okay, But here is important thing. Why we worry only about the eyeball and not about this? Because, let's put it this way. Why we don't worry about this?
Sir, premium value uh, will be, sir, less when the expiry date will be near.
Correct, correct. So what I'm trying to mention here is that what I'm trying to highlight here is that although theoretically we know that we have to be clear about that the time value is affected by two major factors. Okay, I have written it here as changes in eyeball because of what I'm mentioning here. Okay, but theoretically, actually, you have to understand that the time value of an option is affected by two major inputs: this figure, okay, and this figure. Now, in my statement here, I've not mentioned this figure, and that's what I'm explaining. Why have I not mentioned it? Because I've said here that changes in eyeball drive time value, which is a correct statement. Okay, but time value is, so what we're just clarifying here is that why am I not spending time discussing time to expiration and its effect on time value? Because we don't worry about this, because we don't worry about time to expiration, because we know which way the time to expiration will go, as Vipul just mentioned. Okay, we know that this movement goes only in one direction, that it is that with every passing day from the theta of the option, we know exactly how much ceteris paribus, how much the change, 1 unit change in this will affect the value of the option. So there is no, and we also know how this thing moves. Once you buy the option, this variable goes only in one direction. It just keeps dropping. Okay, so whatever this figure is, it always keeps dropping by one day. Okay, every day it will drop by one. So there is no uncertainty. That's why we don't worry about it. Okay, although in theory this affects the time value, the time to expiration. But that's what I'm saying, that there is no uncertainty here. That's why we don't worry about it. Okay. So let me just check the font size here. This is all 14. So make this all 14. So we have, right, so that's why this is the main thing, is that there is no uncertainty. The reason we don't worry about time to expiration, although time to expiration and eyeball, both of them affect the time value, but in discussions we don't worry about this because we know exactly there's no uncertainty with respect to how time and its impact on the option price. Okay? There is no uncertainty. That's why we don't worry about it. So in our discussions we leave this out, because in our planning we need to only worry about, we need to have strategies for only for things which are uncertain. Here there is no uncertainty, so we don't have to worry about it. Okay, it only goes in one direction, and if you're long options, this is always working against you. This is always going to be working against you. So you have to be very clear as to why you're long options and what are you hoping to achieve, right? So what we're going to do is we're coming to our framework, which is what you guys are going to use, which will be very useful for you in terms of your planning of execution of the whole project. So intrinsic value. So you know one thing, that this price, the option price, is going to be driven changes in the option price, and since you're trading options, you will make or lose money based on changes in the option price. Okay, as option prices change, you will make or lose money. So Now the question is therefore, so what is going to drive the changes in the option price? So it's going to be driven by this or this. So this is your theoretical framework. So make sure you understand it very well. So it's going to be driven by these two things. So what is going to, the second level question is, or third level question is, what is going to drive the changes in the intrinsic value? And the answer to that is movement of the underlying. Okay? This is going to drive. So this is fixed, and therefore changes in this is going to drive the changes in the intrinsic value. And what's going to drive the changes in the time value? And the answer is eyeball, because the time to expiration, we don't really worry about it because it goes in only one direction, and we know exactly how it affects the price of the option. No uncertainty. So we worry about this only, okay? So, but there is no uncertainty. So therefore, that now you understand. So we worry only about the eyeball part when it comes to understanding how time value is going to be affected. So first level question is changes in the option price. So the first level question is what is going to drive the changes in the option price? The answer to that is changes in the intrinsic value and the time value. And the second level question is, sorry, it's not third level, second level. The second level question is, okay, for each of these, what is going to drive changes in the intrinsic value and what is going to drive changes in the time value? The answer to the first one is movement of this. And the answer to the second one is changes in the eyeball. Okay. So now we are coming to the framework, which we are going to use. So now that you understand this, you can again read all this, the figure 11 that I've shown you here. I hope we are here. Yeah, we are in this. Now we are trying to views and strategies matrix. We are trying to understand this. Okay. Coming to this. So remember, we are recapping some material that when the eyeball rises, option price will rise. So when you're tracking this, kind of chart, okay, and if this is the red is the eyeball chart, if this eyeball chart keeps rising, so right now it's around 20%, okay, and I'll just make this a little bigger so you can read the 20%. Here is 22.2. It's around 20%. So if it keeps rising 40%, 60%, then option prices generally are going to rise. Okay. So therefore, when eyeball rises or falls, option prices will rise or fall. And then we derive from this, option trading rule 1, which is if your directional view on eyeball is bullish, you buy options. And if your directional view on eyeball is bearish, you sell options. Okay, so remember we are going to, the reason I put DP4 here, if you remember, our decision problem. This DP is decision problem, okay? So decision problem 4 was whether we should buy or sell. Go back to your notes. We have talked about project notes, which we are carrying over from our previous course, but we are continuing with the same decision problem framework. So if you remember, your decision problem 4 was, what should be your buy-sell bias? Okay, that's what I'm talking about here. So when you come to option trading, you have the same set of decision problems. The first one of these important decision problems you're going to face is DP4. That is when you look at options, should you be a buyer of options or a seller of options? We can even have this.
In the chart that you showed us, there was a time when the employed volatility had risen too much, but the option price has decreased significantly. So why was that?
Has increased.
Yes, the volatility had increased and the option price has gone down.
No, this is not the, I hope you're not thinking of this as the option price.
Siddharth.
You were?
I was thinking. Yes, sir.
No. This is not the option price. So understand what this chart is. This chart is nothing but the blue part of it, or the black line, whatever you see, the black line actually. The blue is just the shading. Okay, this is like a, what do you call that, mountain chart or something like that. So this is, only thing it's showing is this one, okay, this time series. So it's showing you the prices of SPY. As you can see, it's around 360 something. So if you go back to this, you'll see the price here on the left-hand scale. You see this price here. This is referring to the price of this underlying equity symbol, okay, the ticker. All right, so the price is around 363. So this is what they're plotting. They're plotting the SPY chart, which you can see here, okay, the price chart. So it's not the option price, it's the, in terms of our framework, if you remember, we have a framework, which is asset prices. If you remember, the underlying asset, remember the concept of underlying, when we went in first, we have the concept of underlying asset. So in the case of SPY options, let's launch this, it will be useful. We are going to make it, since we are discussing SPY, we'll change it to SPY. No, we don't want SP Plus Corporation, we want SPY. We have to click it here. So we want SPY, okay, and we are going to just click on options here so that we can see SPY options. I hope it's giving me option. No, it's still there. Okay, it's coming slowly, a little bit slow. SPY options. So here you see, so good. That's what I'm saying. So what Siddharth has done, a question that he has asked, this is what I wanted. Everybody, anytime you have any kind of confusion, you should ask the question, okay? Because it's obviously a matter of communication. I am trying to communicate something to you. Now, I may think that this is very clear to everyone, but you are a different person. So you have a different way of looking at it, and it may not be clear. I may think that what I'm saying is clear, but it may not be clear to you, and that's why you are supposed to tell me. If you don't tell me, that I won't understand. Any kind of doubt, you have to inform me. Okay, so I've clicked on options. Okay, now it's come here, and I'm going to click on straddle view so I can see calls and puts together next to each other. So this is called a straddle view. You'll understand why, because there's a strategy called a straddle, where you buy both calls and puts. So you see here what we are talking about. Let's look at the put prices. Maybe we should increase the, I want to just show you both in one view. And so we can see that at least in the case of, we'll make it a little bit smaller so we can see a little bit more. So the underlying asset price is 362.56. Okay, what is the underlying asset price? Is this. It is the chart of the SPY, which trades just like a normal common stock of Microsoft or Oracle or Intel. Okay, it's just like a common stock, but except that this is not a common stock. This is actually a one unit in a something like a mutual fund, effectively. Okay, it is a passive. It's an ETF. It's a kind of a passively managed mutual fund. It's a basket of stocks, and it tries to mimic the movement of the S&P 500 index. This is a very famous ETF, very actively traded ETF. So that's what it is. So it trades like a stock, but it's actually not a stock. You can think of it as a stock in a passively managed mutual fund, which is a basket of stocks, which is going to mimic the performance of the S&P 500. So this is the underlying asset price in the case of when we are discussing SPY options. Okay, this is the underlying asset price, which is right now around 363. Okay, and these are option prices. Okay, so we can only see puts right now, because if I scroll down, then I'll lose the view of the underlying asset price. So you can see here that if you're looking at a 175 put, okay, if you're looking at a 175 put, that is worth around 4 cents. Or the last trade in the 175 SPY put was 4 cents for the November 18th expiry. Okay, this is a, you have to remember that options are always discussed with respect to the expiration date. That's why options are not specified until. So if we go on to the, we are going on to, let's say, further down Jan 15th, that will become more interesting if you go there. You'll see that they'll be worth much more, I think. Okay. They are talking about a wider range of options. All right. So you have, let's say if we go further down. Anyway, we have to go further down a lot. We have to go down a lot. But if we see these prices, 777. This is for the 350 put, 350 put, and on the left hand side are these for the 350 put is very close to at the money because the underlying asset price is 362. So these are the things. So we are always monitoring when in the case of options, we are monitoring the option prices, of course, but we are using the eyeball chart, the red line, as a proxy for option prices. So when we see eyeball charts going up, that means option prices were going up, and when they go down, that means option prices are going down. This applies to both calls and puts, prices for both calls and puts. And usually we plot along with that, we are plotting the movement of the underlying asset price. Okay, so this is not the option price, but this is the underlying asset price. Option price you'll have to see separately, and it's generally difficult to plot option prices because you have to plot it for each strike price. For each strike price is a different option price, as you can see here. Okay, these are the strikes, and you have option price. You have so many option prices because even when you lock in the maturity, now there are actually so many maturities. So if you can imagine the combinations, okay, you take each option. If you take each maturity, and then you take each strike for each maturity, can you imagine the number of combinations? And each of those is a specific option. So that's why we generally don't plot option prices, because it will become very confusing. What we do plot is we plot the eyeball chart, which we use as a proxy for option prices. Okay? So this is how you get your display. So if we come back, is this clear now, Siddharth, what I was saying?
Yes, sir. Well,
Yeah.
if we also plotted the actual option price for a particular option,
Yeah.
wouldn't we be better be able to look at the intrinsic value and time value at the same time? Because we have implied volatility here, and from the option price and the underlying price, we would get the intrinsic value too.
Yeah. So you don't need the eyeball chart. See here, if you were plotting the option price itself, okay, if you plot the option price itself, you know which, when you're plotting an option price, like let's say you're plotting this price, okay, let's say you're plotting these are very low price. Let's go down further. Let's take this one, okay, a little bit, 235, okay, 235 put. Okay, on the right hand side we have put. So there's 235 put on the SPY when at a time when the underlying is 360 or something. Okay, 356 or 360. I think 360 or something. 362 or something like that. 363. So if you're looking at this put, this is out of the money actually. 235 strike put is out of the money, but it does have some value. It is 29 cents. Okay. Now this is the value today. Now, if you look at the value tomorrow, or you looked at the value yesterday, it would be slightly different. Day before, it would be slightly different. So you can take those values and you can decide to plot only the 235 call. You can do that. And then you can always plot the intrinsic value along with that, because you can look at the price. You can track the price of this as it is changing over time. And since you can also track the chart like this, which is the movement of the underlying, okay, and so at each point when you have an underlying price, you can calculate by looking at this, okay, by taking this kind of a framework. Your exercise price is fixed, it's 235, okay. So when the underlying price is a certain price, a certain amount, you can see the intrinsic value from that, and then you can plot. So for against each of the plots of the option price, you can plot the intrinsic value also, because you know that you have the data on how the underlying was moving on that day, right? So for instance here, if you take 235 and it's so small actually, yeah, this is where we are, 235, right? So today's price is 0.29. Now, as you know here, today the underlying asset price is actually 363. So here the IV is 0. We write it as 0 because you don't make any money by exercising this option. When the market price is 363, nobody will sell it at 235. No one would exercise this put. So there's no money to be made from exercising the put. So therefore, the IV is written as 0. Although mathematically it is negative IV, but we write it as 0 for our purposes. So against this, you would plot an IV of 0. You would plot this option price and then you would plot an IV of 0. And then of course time value, you know that time value is equal to option price minus IV. So that you will be able to figure out the time value is 0.29. Are you following, Siddharth?
Yes, sir.
Okay, so you can do that. You can do that. But in practice, it becomes impossible to do because there are many options that you might be buying and selling. And there are many option strategies which involve different option strikes and things like that. So therefore, it is generally the correct framework to use when you're looking at option prices is these two. You look at these two. The movement of the underlying asset, which you are seeing here, and the movement of the eyeball, okay, which you are seeing here. That's the right way to look at it because this makes it more manageable. And this allows you to look at a wider range of options. So it's not that the movement of an option price does not matter, because if, let's say, ultimately when you do your trades, you will be doing it in some specific option or the other. So let's say you decided to, buy this put. Then the value of your option position is going to be driven on a day-to-day basis by this figure, which is the price of this option. So it's not that it doesn't matter, but we try to focus on things which drive the price of options and not so much on the price of the option itself. This will of course change every day and it will have an impact on your portfolio value. And so therefore it is of course important. But in terms of our decision making, we try to focus on these two variables, the underlying asset price and how it's moving and how it's likely to move. And the same question for the eyeball chart for that option, for that particular underlying asset. Okay. Remember that this chart will be different. If you change the ticker, if you change the symbol, you change it to Intel, this chart will look different. Change it to Netflix, this chart will look different. So this is different for everything because the option prices behave differently for different underlying symbols. So coming back to the framework that we are discussing, okay, that we have derived because we said that when eyeball rises or falls, we can put this in bold. When eyeball rises or falls, option prices will rise or fall. So if I remember what is my decision problem that I'm discussing, all right, this one, DP4. What is DP4? Whenever I'm trying to look at something, whenever I'm trying to trade in a particular asset, DP4 is, should I buy this thing or should I sell this thing? Okay, so in this case right now we're looking at option trading. So options are my asset. So therefore my question is DP4, what should be my buy sell bias? Well, we have a rule for that because we know when the eyeball rises, option prices rise. While this one falls, this one also falls. So my option OTR1 is, if my view on eyeball is bullish, then I will buy options. And if it's bearish, I will sell options. Okay. So what do I mean by view on eyeball, directional view? Very simple. I have to look at this chart. I have to look at this chart, the red line, okay? Or if you want to take, here you have more data on this. I would recommend try to use this first because it's giving you more data. You can see here, okay? More data on this. The longer I always prefer to look at more data. And you form a view on this, and then you can see a close-up of this over here, basically. Jan 20, which is, I think here, this one you can see from about November, this movement that you can see up and down. You can see it here for 1 year. This movement up and down, same thing. Okay. So now if you can look at this, if you want to look at the last 1 year of movement. So you're going to have to look at this eyeball chart. This is what is involved in option trading. Okay, this is where you're learning the important theoretical inputs that will help you to trade. You have to look at and you're trading options on anything. Right now you're trading options on SPY. So one of the things you're going to have to do is to solve your DP4, should I be buying options or should I be selling options? How are you going to solve that? Very simple. You are going to call up the eyeball chart and you're going to look at the chart, and then you have to take a view. Okay, remember, this is why I'm making you do these projects. All the 3 courses will have projects, so don't underestimate the value of these projects. Okay.
Sir?
Yes.
Sir, in TWS, there is a given eyeball, like in bid and ask price, just like you said that the percentage of showing you the eyeball.
Correct.
Can don't we see that? Don't we consider that compared to this?
No, that is the current price. Okay, so for instance, if you look at maybe at the monies, the eyeball will be around 20%. Okay, so 19% or whatever. Okay, if you see that here, this is basically this plot here is this plot. The visual plot here is this one. It's trying to show you 18.18%. Okay. Right now, that what you're seeing is, so it's a good question. Sachin is referring to the, I have not opened the software today because I was worried about my RAM consumption. So, but he's talking about when you mouse over the bid and ask prices in the case of any option on the TWS, you can see the underlying eyeball figure, the corresponding eyeball figures for the bid and ask.
Yes.
Right? You'll notice always that the bid always, the eyeball is always going to be lower, and the ask is always going to have higher eyeball because offer price is always higher than bid price, and that means the offer eyeball will be higher than the bid eyeball. Okay. Now those are actually just the current figures. Okay.
Yes, yes.
Like if I ask you this, what is the eyeball index mean for SPY right now today? Okay, US markets have not yet opened. Then you tell me 18.18%. Okay. Now there is no skill involved in this. This is like I ask you what is the price of SPY today, and you go to Yahoo. What was the price of SPY closing price on Friday? Today is what? Today is Tuesday or today is Tuesday. Okay, so what was the closing price on Monday? Okay, so you look up Yahoo Finance and tell me the closing price was 362.56. Now there is no skill in this. Even a computer can tell me this because this is just what is the situation now. You don't get paid to tell me this. You get paid to take a view on the future. What's going to happen in the future? So when you take a view, so what you're talking about, Sachin, is the eyeball levels as they stand today, which is like this, okay, like this figure, okay, or this plot of the chart. That you're not getting paid to tell me that. You're getting paid to make a prediction about what will happen in the future, which no one knows, okay? And you have to be right about that. So which means you have to, if you take a view that the eyeball will go up, then it should go up. You understand what I'm saying, Sachin?
Yes, sir. Yes, sir.
Okay. So you have to, just like the same thing that happened at IPM. You had all these charts. You had your favorite chart, FCX. Okay. You did not get paid to tell me that at a point, oh, today the price of SPX is around $21. That everybody knows. There's no big deal in that. You are getting paid to, you're making money if you can predict which way this will go. Is it going to go up now or is it going to go down? Are you following what I'm saying?
Yes, sir. Yes.
You in the IPM project, you were being taught how to take views on the underlying asset. It was much simpler. The framework was much simpler because you were only concerned with the underlying asset. Many of you who are trading, like Vipul, who is already trading stocks, he's already familiar with this kind of framework, except that he's trading Indian stocks. Now he's looking at things like FCX and AES and all these other things, other tickers. But there's no real difference when you look at charts. Okay, you have to look at a chart and you have to take a view. Is this going to go up or is this going to go down? Accordingly, you buy or sell. Now you have an additional complication. You have to keep on doing this, okay, for a different set of tickers, which I've given you. Okay, now we have changed the tickers because we chose it based on option volume. You have a different set of tickers, so you have to take a view on the SPY, you have to take a view on the underlying asset, which I was coming to. But I was first explaining that you have to take a view on the eyeball for SPY, because initially we are coming to option trading rule 1, which is that how should I decide my DP4? How should I solve my DP4, which is a buy-sell bias problem? That means I'm trading options. The first question is, should I be buying options or should I be selling options when it comes to SPY? And then so on and so forth. You have to repeat this. So everything I'm telling you for SPY is going to be repeated for all the tickers. So I'll bring those tickers here. These are your tickers. So whatever I'm teaching you for SPY, we are just using SPY as an example. But you're going to have to apply the same logic, the same thinking steps have to be applied for all your tickers. Okay, you have to keep repeating. Take this, do this exercise, repeat for the next, take the next ticker, repeat, 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 same thing. Okay, so I'm going to explain only with SPY. So you have to now basically do this. So your question is, you're doing SPY option trading. My question is, should you be a buyer of options or a seller of options? How do you determine that? You determine that by looking at the eyeball chart. So first you look at the, here if you can find some software, please tell me. If you can find some website on the internet which is giving you free data beyond this, then please let me know. I'm not aware of anything right now. Remember, we want good data and we want it for free. So therefore, you start with as much data as you can get. Right now, here you have a little bit more data. You look at this eyeball chart, okay? You can see all the time. There is dramatic movement here. So you can see how this is the COVID-19 fall decline in the underlying asset price, okay? So you can see how scary the whole COVID-19 thing was for the option market, because all the while when it was falling here, it did not go up that much. It went up only to 40%. But here, because of the fear around the COVID, how you can see how much the eyeball shot up. Okay? So you can see this. So you have the historical context. Okay. So you can now also make an estimate. Okay. At this point of time, eyeball went up this much because we had very little information on COVID. We did not know how it was spreading and all these kinds of things. So maybe the market got much more scared. Maybe that right now we have more information, so it may not go up that much. But remember that eyeball moves not just because of COVID. COVID is just one factor affecting market prices, asset prices. Now there could be uncertainty about the election. So you don't know. There's no guarantee that it will not go up to this again or even more than that. There's no guarantee of anything. So you will take a view, you'll look at the long-term eyeball chart, then maybe you'll come down to a short-term eyeball chart here, last 1 year movement. But then you're going to have to take a view on the golden line, which is the eyeball chart. Okay, you have to take a view. Which way is this going? In your case, since your trading project is only 4 weeks, it's a very short-term view. I understand that, but you're using this project as a learning tool for future option trading. So you have to think a little bit beyond the project also. Mainly, you're learning that if you want to trade options, if you want to be a buyer or seller, should you be a buyer of options or a seller of options? That question is answered by looking at the eyeball. Okay, looking at the eyeball chart and taking a view on the eyeball. Which way is this chart going to go? And there is obviously risk in that. You can never be 100% right about that. And you can still manage actually. So this is what we have to be aware of. And this is what I was saying, that why am I making you guys do these trading projects? As I said, this is a very unusual way of teaching finance. In most business schools, they don't do these kind of projects, which I've checked from some of your, you can also let me know from your own friends, but your previous batches, most of the business schools are not doing. Even in IIM Ahmedabad, they didn't teach us with these projects, live trading projects. We were taught from textbooks. So, therefore, this is an unusual way of doing it. Why am I making you do it like this? Because I want you to understand how prices actually move in the real world. Because in the real world, when you take up any job in finance, it's going to involve some kind of taking, some kind of view taking. You will have to take a view on either the movement of eyeballs, or you will have to take a view on the movement of underlying asset prices like you did in IPM. You will also have to do that in this project. So always taking a view. As Sachin was saying, yes, you can see the current values in the TWS when you mouse over the option prices. But then there is no skill in telling me what the current value is. That's just your information. The real skill is in telling me what the future will be. Okay. So that's why you have to always take a view. In any finance role, you'll have to take a view. Take it from me. I'm telling you that in any finance role, it will involve some taking views on market prices, either bond prices or commodity prices or equity prices, currency prices. You're always having to take a view. And this taking a view is a very risky business. You can never be 100% right. And most of the time you'll be wrong. And then it's a question of how do you manage when your view is not correct. Okay, so all those kinds of those types of planning, that's what finance jobs are really about. Okay? And that's why I make you do these live trading projects, because they give you a first-hand feel of how markets actually move. You would have seen many times, because of uncertainty around COVID, US elections, prices are moving around up and down. Okay, so you can see how difficult it is to predict. And so you're learning that firsthand. All right. So as you see, many times Vipul has asked questions which are very much, very good questions actually, where he's getting to the heart of the matter, that there is no, I mean, essentially what he was saying is that, you know, if I do this, I could lose money. If I do that, I could lose money. Yes. So that is what it is basically, that whatever you do, there's no guarantee of profit. You're always taking a risk. And so he was essentially getting to that kind of reality, which is what I want you guys to do. I want you to understand that, and understand that reality, and understand and figure out a way in your own way. Everybody will deal with it differently. How to deal with that uncertainty, and that's how you evolve your own trading style. Okay? So we are getting to this framework. Okay, we are trying to figure out this thing. The views and strategies matrix will help you to take decisions. First decision problem is, should I be a buyer or seller of options? That you decide by taking a view on eyeball. Eyeball bullish, buy. Eyeball bearish, sell. View is bearish, sell. Okay, that's one. Second is, the first is implied vol. View on implied vol. And the second is underlying market. What is the underlying market when we are trading SPY options? The underlying market when we are trading SPY options is SPY common stock, okay, which is this price. And what you see here is the time series plot of that price. Every day they take that snapshot, and this is what you get. This is the kind of data that you have. Okay, this is just 15 minutes. We can make it longer, then you have more data. See here, now we have more data, and you see how it looks very much like this. Here, see this rise, this fall, this is the COVID related fall, and you can relate it to this rise and this fall here. Okay, so it's the same chart. So this is the underlying asset price. When you're trading SPY options, this is the underlying asset price. When you're trading other options on other tickers like IWM, then you'll have to put IWM here. You'll have to change this to IWM. Here also you have to change to IWM, and here as well. Okay. And symbol has to be changed. But it's the same logic. The thinking process does not change. What is the thinking process? The second part, we are coming to OTR 1 is ready, OTR 2 and OTR 3. What is the OTR 1 and 2 and 3? OTR 2 and 3 here. If you are on the underlying market, your view is bullish, you have two options. You can either buy calls or you can sell puts. Okay. You can think about this more a little bit later, but I want to get to the matrix today quickly. So obviously, underlying market is bullish. You can either buy calls or you can sell puts. Buy calls. Why? If you buy calls, what will happen? let's say the underlying price, let's look at the price here. Let's look at the exercise price of 100, okay? So the call is 3.02. Why are we saying buy calls? If the underlying asset, if your view is underlying is bullish, okay? Let's this here. We are saying if the underlying view on the underlying market is bullish, you buy calls. Why would you buy calls? That means that you are expecting to make money. The call prices will go up and you bought them, so then you'll make a profit. The call prices will go up if the view is correct. Underlying market is bullish. Underlying market is bullish means prices will go up. Underlying price, let's say it goes from 100 to 150. Taking an extreme example. See what happens to the call option price. What is the intrinsic value here at 100? Intrinsic value is 0. Okay, at the money option. Intrinsic value is 0. What happens to the 100 call when the underlying shoots up to 150? Look at the option price, 3.02. Let's change this rounding. Where does it go from 3.02? It goes to 50. All right. Because the intrinsic value has already gone to 50, as you can see. Because by exercising at 100 and selling it in the underlying market at 150, you can make $50 of profit. So theoretical price already $50 plus a little bit. This is your time value. Total price is this. Intrinsic value is 50. So time value must be the balance of that, which is 0.29. All right. Now notice what happened to the put option. It used to have some value when it was 100, when the underlying was 100. But now the put option value has gone to 0 because the put option is deeply out of the money. And the call option, at this point we say the call is, we use the word deep, okay, as in and the opposite of shallow. We say the put option is deep out of the money or deeply out of the money, and the call option is deeply in the money. That means essentially that it's referring to the intrinsic value. This has very high intrinsic value, the call option, and this has 0 intrinsic value. And because of how deeply it is out of the money, it has no time value also. So now what you're seeing is the statement that I just made here. If your view on the underlying market is bullish, you buy calls, obviously, because if your view turns out right, your calls will go up in price, you will make money. Or you sell puts, that also makes sense now. You can see if you had sold the put when it was 100, now the put has gone to 0. When you sold the put was, you go back to 100 underlying, the put was worth 2.7. You sold it and now the put is worth 0, so you're making money. So okay, so this is clear. You can think about this a little bit later. Make sure you understand the logic. So we are deriving OTR2. Okay, if you're because earlier we dealt with buy or sell options. When we say buy option, sell option means let me make sure I make this clear. Okay, so when you say buy options, we're talking about both calls and puts. But now you may be a little confused. Now, should I buy call or put? Because in practice, you can do both, but you may want some more refinement. Okay, so now we're talking about how to refine further, OTR2. If your underlying market, so what you do is, you look at this. Okay, you look at this here, or you look at this on the same chart here, this one. Same thing, you look at this line. We look at it here because it's cleaner. We look at this here and we ask ourselves, is this thing going up? If my view is this thing is going up more, Then I will be a buyer of calls and I will be a seller of puts. So now my advice is more specific. If my underlying market view is bullish, I'm a buyer of calls and seller of puts. And you can work out the flip side logic. Okay, I'm not going to go into that at this stage because I want to go to the matrix today. And if the same thing, if the underlying market view is bearish, you obviously will reverse that. You will, instead of selling puts, you will buy puts, and instead of buying calls, you will sell calls. Okay, this you work out for yourself. You go back and think about it. Make sure you understand it and work through the logic. Go to this model and see what happens if you follow this advice. Do it for yourself. Buy puts and make the underlying market price go down. Make it go down. Make it go down to 70 and see what happens and make sure that you understand. Only then will you really understand it properly. Okay, remember, if you understand it conceptually, do a little bit of hard work right now. You understand it conceptually, then you will never forget it in your life because it's logical. Okay, so you have to understand it that way. Now, from these three, so this is OTR 2 and this is OTR 3. Okay, now we combine OTR 1, 2 and 3. This is what is going to be very useful for you. This again is my own framework. You will not find it anywhere else, but this will be very useful for you to trade, do your project. I hope it goes to the right sheet. Google links are very smart now. They go to the right sheet. Okay. Here, this is your framework. Make sure you understand this. We have only 5 minutes left. It's a very important framework. And once you've understood, this comes from our 3 OTRs. 3 OTRs. 1, 2, and 3. Okay. That will give you this framework. And once you understand this framework, it's very easy for you to trade options. But of course, the hard part is taking the views. So let's look at this. This is meant to be a box. Of course, there is, you have to pardon my drawing skills. You have 2 things in the matrix. On the one side, you have in the columns, you have the eyeball. Okay, these are the views. Okay, what is my view on eyeball? Am I bullish? Am I bearish? What is my view on the eyeball chart, which is here? I look at the red line. What is my view? Do I think it's going to go up? Am I bullish? Do I think it's going to drop further? Am I bearish? That's what I mean here. Okay. Then here is talking about the underlying asset. Okay, so when I look at this chart, this line, okay, or I want to go discrete and I want to use this chart here. Okay, I look at the underlying asset price in a clean way. What is my view? Am I bullish? Am I bearish? That is being shown here. Okay, these are all views. Okay, so this is the views this is the views into a strategies matrix. Now, here you have 4 strategies. Remember, this goes back to the 4 option positions. Somewhere here we discussed today, earlier in the morning. We have 4 option positions. Long call, long put, short put. 4 option positions. Then we looked at the time value and intrinsic value dynamics. We looked at all the eyeball movements, okay, and the views and the eyeball charts and the underlying market charts and the views. We got the 3 OTRs, and now we have this. So now that you have this, we don't have to spend too much time on it, okay, which is very simple. If your eyeball view is bullish and your underlying asset view is bullish, you're a buyer of calls. Okay, this buy comes from this part and the call comes from this part. Eyeball view is bearish, that means you're a seller of options. See, eyeball view bearish, both are sell. Eyeball view is bullish, both are buy. Buy what? Buy call or buy put? Not clear. Well, that depends on your underlying asset view. If your underlying asset view is bearish, you will buy puts. If your underlying asset view is bullish, you will buy calls. Okay. So now this is basically it. As you can see it, very simple. And then let's go through this. Underlying asset, eyeball view is bullish. Underlying asset view is bearish. You will be a buyer of puts. Underlying asset view, eyeball view bearish. And this is bearish both. You will be selling calls. So you can figure out all your four. Now it's very simple now. Now what you should do is now have this list of tickers. Go to each of the tickers. Repeat. I'm going to show you for one. You repeat. Look at the SPY. Take a view on the underlying. Take a view on the eyeball. What is your view on the eyeball? What is your view on the underlying? Depending on where you are, okay, so suppose Sachin is bearish on the underlying asset and bullish on implied volatility. So he's bullish on the eyeball chart and he's bearish on the underlying asset. So he goes into this box. So Sachin will be a buyer of puts. Okay, so in this case, now, so what you should start doing is you have the list of tickers with you. For each ticker, you should be forming a view. You can look at this one. I prefer to look at this because it gives me a cleaner view of the eyeball chart of the underlying asset price, and I have more data. Then I look at the eyeball chart, take a view of the eyeball, find out where I am, and then I would accordingly, Sachin will be a buyer of puts. Okay. So, and then you'll do some practice and then he will watch what happens. Like going back to what Siddharth was saying, tracking one particular option price. So Sachin will have to decide which put to buy, expiration date, which strike price. Those we will come to later, those decision problems. But at least you have solved quite a few of them. I'll just finish off in 2 minutes. So you've got a framework for trading options. And then we will now later on tell you 2 more decisions you have to take. You have to decide which option to buy, expiration date, which one. Okay. So these are already in your notes. I think they're already in your notes. But generally, I would say longer term, I'll give you a very quick guide. In general, when you're buying options, go long term. And when you're selling options, go short term. Short term means 15 days or less. Okay. And long term means anything more than that. Don't worry about your project being only 4 weeks. You go as further out as you can, where you get good bid offer prices, low bid offer spreads. So buying options go long term, selling options go short term. And in terms of strikes, you try to choose the strike, which is, remember this rule, low eyeball means low option price. So if you choose those strikes which have low eyeball and for buying, if you're buying, because low eyeball means cheap options. And high eyeball means expensive options. So that's your basic guide. We'll go into that in detail. Okay, so your class is dismissed for today. You should start trading now. You should start practicing. You know your project start date. I've already showed you. Okay, so get ready. If you have any questions, of course, you can always call me at any point of time. We can fix a Zoom meeting if it's a long discussion. Okay, so your class is dismissed, guys. You can go, and those who have questions can stay back. Mitali should stay back. I just have one question for you administratively. But before that, we'll ask people if you have any conceptual questions from what we have discussed. Does anybody have any conceptual questions? No? Okay, fine. Yeah, okay, great. Mitali is here?
Yes, sir.
Okay, so that you can stay back. The rest of you can go. Yeah. So I'll just stop the recording and then I'll just start. So I'm just stopping it because I'm assuming here nobody has any conceptual questions. So I'm stopping the recording. Okay.